As a Barefoot Investor reader, there's every chance that you've used the multiple of salary method for calculating how much insurance you need. Now, one thing that I couldn't find was the reason this multiple of salary method had been suggested. So instead of making you do the legwork yourself, what I've done is I've gone out and had a look for why this was recommended and whether or not this is the right solution for you when looking at how much insurance you need. As a kid growing up, baseball was my life. I loved it so much. My main dream was to become a major league player. When I was 15, we got an opportunity to go to the US on a trip with my team. We traveled around, played a number of games, but we also got to experience a lot of the US life. I bought more baseball stuff, more hats, more everything that I'd ever bought in my whole life. And I remember vividly, I walked into one shop and something caught my eye. It was a yellow shirt and I had to have it. Didn't matter what was on it. I grabbed it and I bought it and I took it home and I wore it that night to the baseball game that we went to. And I went to the game feeling pretty happy with myself. This was also a pretty awkward time for me. I was a teenager. My nickname on the trip was actually Terry Tagalong. So I didn't really need to be giving the guys any extra ammunition. When I got there, one of the boys looked at me and said, "Do you even know who the Wu-Tang Clan is?" I was completely embarrassed and I looked at him with a blank face, because I had absolutely no idea who the Wu-Tang Clan were at the time, and yet I'd bought their shirt and I was wearing it feeling $1 million. The reason I'm telling you this is I remember promising myself that I would never put myself in that same position, that I'd be so embarrassed by a simple question that I couldn't answer. So my simple question to you is, why have you used the 10 to 12 times salary for figuring out your insurance? Firstly, let's have a look at how the multiple of salary method works and explain the basics of this strategy that Scott suggests in his book. When looking at your life and TPD insurance needs, Scott suggests having a multiple of your salary to determine how much insurance you need. To use an example, if your salary was $100,000, Scott suggests between 10 and 12 times this salary as the amount of insurance that you should have for life and TPD. Using this same example, that would mean that you'd have between $1 million and $1.2 million worth of cover. As I mentioned at the top of this video, the thing that I found difficult was finding the reason that he'd suggested these numbers. I spent a lot of time searching online and came across a guy called Dave Ramsey, who is the equivalent of the Scott Pape over in the US. Dave has a YouTube channel that has over 1 million subscribers. He gets a huge amount of traction and views, and he's regarded as one of the leading experts in the finance space over in the US. Now, Dave and Scott's advice is very similar. Dave uses this same 10 to 12 times strategy to suggest the life and TPD cover amounts. And one of his callers on his popular show, as I mentioned before, rang in and asked this specific question as to why this had been suggested. I'll include the link to the video down below that if you've got a couple of minutes, it's a really good watch. Dave gave a perfect explanation for this and explained the fact that the 10 to 12 times salary was used based on the return that you'd receive on the money once you'd been paid out from the insurance company. So using the earlier example, if you had a salary of $100,000, at 10 times your salary, that $1 million worth of cover would be recommended. The reason that this has been suggested is that when you receive that money as a lump sum, there's an assumed earning rate of 10% on this money, which would mean that each year on your $1 million, you'd receive that $100,000 worth of income that you need, and your $1 million would be preserved forever. The reason that there's a variant being the 12 times salary and giving you a little bit more insurance is to allow for a lower rate of return. Now, what I mean by that is if you had $1.2 million to give you that same $100,000 worth of income, you'd actually need a lower return of about 8.3%. Given that the interest rates on cash are coming down at the moment and the share market's quite volatile, this more conservative rate of return is, in my opinion, a better option. So this is a really good explanation of how the multiple of salary method works and the reasons behind it. Now, moving on from that, there are some limitations to this, and using Dave's example, he suggests a term life insurance policy for the 10 to 12 times salary. Now, without getting too technical on this, basically that means that the life insurance policy has a lifespan. So instead of the policies that we have here in Australia, most typically we have these through our super funds, and the insurance will remain in place right through to the age of 65, with some policies even being through to the age of 99. So these term life insurance policies that Dave suggests are not available to us here in Australia, meaning that it's not really suited to our Australian market. In Dave's video, he also explained that there was no ability to personalize these numbers, and the caller that rang in actually had a huge amount of assets, so they had some cash and investment property and that sort of thing too. And the 10 to 12 times salary didn't give any flexibility to personalise the numbers, and should they have used the 10 to 12 times salary, Dave mentioned they'd actually have too much insurance in place. Now, my belief that you would have seen in earlier videos is that the need for insurance that we have reduces over time, meaning the younger we are, the more we need to rely on these insurances to help get us back on track should anything happen. As we get older, our kids grow up and get older and have less reliance on us, we typically accumulate more wealth, and therefore we need less insurance over time. To highlight this, I just want to break down and give you two examples. Family number one is a young couple in their 30s. They've got two young kids, they've got other assets including cash and super balances of about $100,000, and their income is about $100,000 as a family. Family number two, we essentially fast forward that same family 10 years. This couple's now in their 40s. They've been able to pay down their mortgage and they now owe about $500,000 on their house. They've also accumulated more wealth. Their super balance has gone up, they've got some more money in cash, and they've got other assets of $200,000. And also the family income has gone up from $100,000 to $200,000. So I'd ask you the question, out of family one and family two, which of these families do you believe needs more insurance? Looking at family number one, using Scott's example, they need anywhere between $1 million and $1.2 million worth of life and TPD cover. Now, using my method, which is available in the comments section below, I believe this family needs $1.6 million worth of life insurance and $1.4 million worth of TPD. These numbers that I recommend, as you'll see, are above what Scott suggests. Now let's move on to family number two. If you remember, their income as a family was $200,000. So using Scott's recommendations, they'd need anywhere between $2 and $2.4 million worth of life and TPD cover. Again, using my method, I believe that this family would need $1.2 million worth of life insurance and $1.1 million worth of TPD. I believe that this is a pivotal difference, and I'll show you exactly why right now. If you've had your insurance in place for any period of time at all, you would have noticed that your premiums only tend to go one way. They increase as we get older. I've done some quotes on a graph to give you an example of exactly how this works for a few different age groups. I've looked at $1 million worth of cover of life and TPD, and I've even quoted it with Host Plus to give you an exact example of how much this would cost you. At each different age, I've used that same $1 million worth of cover, and you'll notice the difference in premiums. At age 30, the premium would be $965 per annum. At age 40, the premium would be $1,722 per annum. At age 50, it jumps dramatically to about $5,200 a year. And at age 60, it's just ridiculous at about $14.5 grand for that same level of cover. This just highlights how important it is that as we get older and our need for insurances reduces, we need to reduce the amount of insurance we have so that we don't pay too much in premiums. So here's what you can do instead. In my belief, you should always have purpose-linked insurance cover. If you do this, you'll know exactly why you have the amounts of cover at any period of time, and it will also give you a framework for coming back and revisiting these numbers in incremental periods. As I've just shown you, as the price goes up so much, if you don't need that cover anymore, you're essentially paying for things that you don't need anymore. If your goal, like mine, is to have the minimum amount of insurance at all times, then coming back and reviewing the amount of insurance that you have as your needs change to keep your premiums lower is critical to help spend less over the journey on your insurances. As Scott mentions in his book, the multiple of salary and a lot of his other recommendations are really good as a starting point. But if you need to personalize the cover level further than this, and you want a framework for reducing the amount of cover you need as these premiums go up and as your needs come down, then I believe that looking at this purpose-linked insurance solution is a much better option for you. If you have any questions or comments, leave them in the section down below. Thanks again for watching, and I'll see you all next time.